Hey guys, welcome back to Money Farming YouTube channel. And in this video, we're gonna be continuing our reading session on trading agents, multi-agents, LLM financial trading framework. All right, so let's continue with the experiments and know how how they ran the experiment, back trading, and result and analysis, performance comparison, and all this stuff. Okay, so let's continue. 5.1 simulation setup. We evaluate our trading agents framework using a comprehensive backtesting simulation from January 1st to March 29th, 2024. So January, February, March, around 3 months of backtesting, I suppose. Or it could be, January 1st, 2024 to March 20. Across major technology stocks including Apple, Nvidia, Microsoft, Meta, and Google. Okay. Trading agents facilitate seamless plug-and-play strategies during the simulation, enabling straightforward comparisons with any baseline, right? So basically, it says that we have with trading agents we have like decoupled the system from other um, like components that it's very easy to plug and play with another strategies as a baseline to test the robustness of the trading agents that we have. Okay, agents make decisions based solely on data available up to each trading day, ensuring no future data is used. Okay, eliminating look at bias and all this stuff. Okay, based on their based on their analysis, trading agents generates trading signals to buy, sell, or hold assets, which are then executed. Okay. So if this trading agency generates three signals, buy, sell, or hold assets, which are then executed by the managers, right? Now, afterward, analysis metrics are calculated before proceeding to the next day's data. That's good. So we benchmark against five established strategies: buy and hold, MACD, KDJ plus RSI, ZMR, and SMA baseline descriptions in appendix. We have this. Performance is evaluated using four key metrics, which is cumulative return, annualized return, Sharpe ratio, and maximum drawdown. Okay, so let's read the back trading 5.2. To simulate a realistic trading environment, we utilize a multi-asset and multi-modal financial data set comprising of various stocks such as Apple, Nvidia, Microsoft, Meta, Google, and more. Our multi-modal dataset integrates historical stock prices, news articles, social media sentiment, insider transactions, financial statements, and 60 technical indicators per asset. The dataset includes this is guys very important part. Okay, data collection and so they are listed out the data collection plan really well. And yeah, so like you can see here data flow. See this folder data flow. So you have basically FinHub utils getting data from FinHub, right, in the JSON format, then Google News. Okay, then interface. Sure. It's basically we are getting all the data, and whether it's CSV format or just like PDF format and all this stuff. You see ticker to company, around 50 different, right? Yeah, there's a lot of here. 11, 48, 7, 3, 37, 7 companies. Fetch top from company. Okay. Category to fetch top posts from collection of subreddits. Okay. Cool. Stock stats utils. Very simple for the company. Quantitative indicators based on the stock data for the company. Current date for retrieving stock price data. Directory where the stock data is stored. Whether to use online tools to fetch data or offline tools. True, will use online tools, right? All right. Details. Python utils. All right. So historical stock prices. We are getting the data here. Historical stock prices. Yeah. Open, high, low, close volume, and adjusted close prices from January 1st, 2024 to March 29th, 2024. Okay. News articles, daily news updates are gathered from diverse sources such as Bloomberg, Yahoo, EODHD, FinHub, and Reddit, covering specific company developments, global events, macroeconomic trends, and government updates. Right. Another is social media posts and sentiment. Posts from Reddit, X, Twitter, and other platforms, along with sentiment scores of posts calculated by auxiliary language models. Right? Social media posts and sentiment. Posts from Reddit, X, Twitter, and other platforms, along with sentiment scores of posts calculated by auxiliary language models. Cool. Insider sentiments and transactions. Sentiment derived from public information, including transactions from SEDI and relevant company filings. Okay. So these are just like insider transaction and stuff like uh, what you don't have in like companies' earning reports. That's kind of information that they're talking about, and like you can actually get it from FinHub and all this stuff. Okay, even from Google News. Financial statements and earning reports, quarterly and annual reports filed by companies, company profiles and financial history, descriptions of company profiles, target industries, and financial history reported by third parties. And then technical indicators, 60 standard technical analysis indicators calculated for each asset, including MACD, RSI, Bollinger Bands, etc. Okay. So this is the formation of all the data gathering process, which is in available in data flows. And guys, don't worry, we're gonna be running this CLI soon enough, like and yeah, don't worry about that. We're gonna be running this code and like getting all the analysis for like in CLI technical. If I go see all this analyst team, research team, trading team, risk management team, they are running the analysis. Then codes here, then market analysis, current report market analysis, and trend analysis, the summary of market conditions, recommendations, selected indicators, all this stuff like it's gonna give us as a response. Okay. See, now we have like analyst team, research team, trading team, risk management, portfolio management team. Their reasoning, and then like as a risky analyst says, risky analyst, I see the conservative and neutral analysis uh, leaning heavily on the macro slowdown, valuation concerns, and geopolitical risks to justify trimming SPY exposure by half. Like So this is some really good reasoning, guys. Like if you read it, like you'll it will make sense for sure. Yeah, and that's what we're gonna be doing as well. So let's read the results and analysis, and then yeah. So in this section, we present the experimental results and analyze the performance of trading agents in comparison to the baseline models. Okay, what we see here, um, figure six here, 6.1 performance comparison, cumulative and annual returns. Table one in figures six. Okay, table one in figure six, 7 S1, S2, S3. Their appendix. S1, supplementary materials for trading agents. Okay. S2, S2 here. Cumulative returns for Amazon performance comparisons showing cumulative returns. Well, okay. Let's go back. Hmm. Table 1 figures 6, 7, S1, S2, S3, and S4 demonstrate that our method outperforms existing rule-based trading baselines, right? Particularly in profitability as measured by returns. You can see, returns, cumulative returns 26% up, annual returns is your 30% up, Sharp ratio up by 8.21, and maximum drawdown is less by 0.91. Overall, the improvement is like substantial, guys. It's like, yeah, it's really good. Yeah. Trading agents achieves at least 23.1% cumulative return and a 24.90% annual return on the three sample stocks, surpassing the best performing baselines by a margin of 6.1%. Notably on Apple stock, a particularly challenging case due to the market volatility during the testing period, the traditional methods struggled as their patterns failed to generalize to this situation. In contrast, trading agents excelled under these adverse conditions, achieving returns exceeding 26% within months. See, 26% within months. This is some really good result, guys. Like really, really good one. Okay, here we had on Amazon. See, and you can see the performance of the model. know. This is for trading agents, right? And all these others are like these traditional indicators taken by the trade from that, and you can see the performance is worse for the traditional, but for the AI, it's a steep rising curve. You know, that's your exponential curve, guys. The result should be like that. It should exponentially go up, and that's what we are seeing here. It's really good. Okay? So we can see on table one performance comparison across all methods using four evaluation metrics. Results highlighted in green represent the best performing statistic for each model. Results highlighted in green represent the best performing statistic for each model. The improvement row illustrates trading agents' performance gains over the top performing baselines. The improvement row illustrates trading agents' performance gains over the top performing baselines, right? You see, I mean, like in all of these stocks, Apple, Google, Amazon, the trading agents performed really well. Okay, here we can see as well cumulative returns on Apple using trading agents. The figure shows the performance comparison of our model against baseline approaches for Apple in stock, stock analysis. All right, cool. So, Sharp ratio. The Sharp ratio performance highlights trading agents' exceptional ability to deliver superior risk-adjusted returns, surpassing all baseline models. Right. This result underscores trading agents' effectiveness in balancing returns and risk. Okay. Crucial factor for sustainable and predictable investment growth, right? Which is a crucial factor for sustainable and predictable investment growth. We have really good Sharp ratio. It shows that like your average win or average loss is really good, right? And basically, it shows that like um, if as you have bigger Sharp ratio, you have really good strategy. That's the that's really a big factor in judging the performance of the model. Trading agents outperforms market benchmarks such as buy and hold. You see all this strategy, buy and hold strategy, this blue line, and rule-based strategies consistently demonstrating its adaptability. Okay, so this was your buy and hold, this blue line. Your orange line was MACD strategy, you see, it also failed. KDJ RSI strategy, this green line also failed. ZMR strategy, red line also failed. SMA strategy, purple line also failed. Trading agents, this brown line, and it's going steeper and steeper upside, right? So that's your like exponential curve. Okay, that's your exponential growth, and that's what we need in trading strategy. Okay, we have very less drawdown, and this is our exponential function. Okay. Um, its capability to maximize returns while maintaining controlled risk exposure establishes a strong foundation for multi-agent and debate-based automated trading algorithms. Yeah, it is. It is really good. We can see, Sharp ratio increase here, 8.21 here, 6.39 here, 5.60. Like, I mean, people in the trading firm, they actually like they will hire you if you have like three Sharp ratio, and this is like 8, 6, 5. So guys, just imagine like how the trading industry is gonna shift now. Um, you know, there's gonna be already like a lot of trading agents trading, but like we haven't gone there. There's gonna be a lot of demands for trading agents right now, and we'll see what happens. And that's why in this channel we are ahead of the curve, and we wanna do the latest research that's going on in the trading world. Okay, so let's continue. Maximum drawdown. This is also very important. While rule-based baselines demonstrated superior performance in controlling risk, as reflected by their maximum drawdown scores, they fell short in capturing high returns. Okay. Even if they demonstrate good performance in controlled risk, the baseline strategy, their drawdown is like very high, which is not good. This trade-off between risk and reward underscores trading agency strength as a balanced approach, right? Despite higher returns being typically associated with higher risks, trading agents maintained a relatively low maximum drawdown compared to many baselines. I mean, we can see the drawdown is not much, Drawdown is like, when we have like suppose this and market comes down. So this is our drawdown. I mean, this think of it as like cumulative returns. Then from here, like we go, then we have another drawdown, and then again we go like this. So this we have to avoid, and that's what it's doing perfectly on the trading agents framework. So yeah, um, despite higher returns being typically associated with higher risk, trading agents maintained a relatively low maximum drawdown compared to many baselines. Its effective risk control mechanisms, facilitated by the debates among risk control agents, ensured that the maximum drawdown remained within a manageable limit, not exceeding 2. This demonstrates trading agents' capability to strike a robust balance between maximizing returns and managing risk effectively. Right. So this basically capability to strike a robust balance between maximizing returns and managing risk effectively. Okay. What they say here, we benchmark trading agents over 3 months due to intensive LLM and tool use, 11 LLM calls, and 20 plus tool calls per prediction. The highest Sharpe ratio exceeds our expected empirical range. That is Sharpe ratio about 2, very good, about 3, excellent. We exported trading agents' decision sequences and examined them to ensure calculation correctness. We believe that we believe the exceptionally high Sharpe ratio resulted from the phenomena that there were few pullbacks in trading agents during that period. Okay? We report results as they are in our experiments faithfully. Future work will optimize LLM reasoning and tool use to enable longer backtesting under limited budgets. Yeah, I mean, this is what I was also thinking. 3 months data, it's like not much enough, but still, I can understand. It's like 11 LLM calls, like 20 plus tool calls, and per prediction. Yeah, it's a lot of calls. Yeah, I mean, like one prediction, I think it's gonna cost around like $10-20 or something. Yeah, like let's see. But by the way, overall, they're saying that they have analyzed the data and the returns from the agent, and what they notice is that the Sharpe ratio that resulted from the phenomena that were there because of the few pullbacks in trading agents during that period. Okay, so let's continue. This is very important, guys. This demonstrates trading agents' capability to strike a robust balance between maximizing returns and managing risk effectively. So it's basically this like balance between risk and reward. Like if we are risking like one, and we have, if we are risking like suppose $100, we should be making 200 or $300. And the model will automatically, the agent will think about it like over a series of trades and make optimal decision. And that's why it's the return is this much because it's doing a lot of thinking. Um, so yeah, I mean, result speaks for itself. Even for 3 months of data, if it's performing this much really good, yeah, we gotta see, like we gotta put it into test. To be honest, do the live trading and see how it goes. So 6.1.4 explainability. A major drawback of current deep learning methods for trading is their dense, complex architectures, often rendering trading agents' decisions indecipherable. Okay? This challenge, rooted in AI explainability, is critical for trading agents operating in real world financial markets, where incorrect decisions can cause severe losses. Okay? Now, in contrast, an LLM-based agentic framework offers a transformative advantage. Its decisions are communicated in natural language enhancing interpretability. To illustrate, we provide trading agents full trading log for a single day in the appendix, showcasing its use of React style prompting framework. Each decision includes detailed reasoning, tool uses, and thought processes, enabling traders to understand and debug the system. This transparency empowers traders to fine tune the framework, accounting for decision factors, offering superior explainability over deep learning trading algorithms. Yeah, guys. So, I mean, this explainability problem, this actually, I also used to have when I was building a pure deep learning trading strategies. Like you can't really tell like what's going on between this, like the nodes connection, the neural nets, and when we move on to LLM based model, we are actually interpreting all the results in natural language. So so basically, we already know what it's thinking, um, and what was the result, and what was its decision making process during that action, right? So that's what I think they are listed it in this React style prompting framework. So let us go there and see appendix, right? Yeah, this one, police opinion. So the yeah, trading agents, market analyst team, Apple, role specialization and cooperation. Okay. I think we're gonna be reading this in detail later on, and because we have to analyze it further. Trading agents fundamentals, knowledge stream, Apple. Okay. Cool. Trading agents research team, bullish opinion. Trading agents research team, bearish opinion. Apple. Management team, conversation agent. Management team, natural agent, neutral agent, fund manager. That's it. Okay. So each decision includes detailed reasoning, tool uses, and thought processes that we just saw, right? Enabling traders to understand and debug the system. This transparency empowers traders to fine tune the framework, accounting for decision factors, offering superior explainability over deep learning trading algorithms. This is so true, guys. I'm telling you. Once you can explain the model in deep learning, um, then basically it's so much transparent, what's going on in their thinking process. We can actually assess and see, basically that's the point where your improvement starts, and it just keeps going up. Model is going to improve for sure. All right. So with this explainability, um, there's there's no limit to how good this model can perform. So yeah, I'm actually hoping some really good results when I start back testing and running the simulation and stuff. So yeah, let's see how it goes. Our results demonstrate that integrating multiple specialized LLM agents and fostering agentic debate significantly enhances trading performance. Well, yeah, I mean, I can see why not, why is this why could this be the case, right? This framework efficiently synthesizes diverse data sources and expert analysis, enabling trader agents to make well-informed decisions tailored to specific risk profiles. Okay. The inclusion of a reflective agent and a dedicated risk management team is pivotal in refining strategies and mitigating risks. As a result, the framework achieves exceptional return capture while maintaining strong risk management metrics, striking an optimal balance between maximum rewards and minimizing risks. Additionally, the natural language-based operations of the multi-agent LLM framework ensure high explainability, giving trading agents a distinct advantage over traditional and deep learning methods in transparency and interoperability. Yeah, guys, there we go. What this model has done is you know, see, first of all, like we have to think that you know right now in this like AI era, we are at a point where AI can make decision on its own. So we have to leverage it, and that's what this paper shows. And this paper is not that old. I mean, like that 3rd of June, man. It's like almost 1 week. 10 days, 2 days, 13. Um, yeah. So think of it this way, okay? Um, if you suppose you want to hire a trader, okay, for your trading account, and what sort of the question you're gonna ask the trader, do put that question into LLM and see their response. If you are satisfied with their answer, with its answer, then you can actually rely on this LLM's response to suggest your trading decisions, right? And what they have done in this paper is combining all these different agents. Like there are like 20 different agent calls. Like hang on, see, 20 plus tools, 11 LLM calls, and 20 plus tools calls per prediction. You see, so like it's basically building a super intelligent human being who makes trading decision for you. You know, and yeah, that's just amazing. Yeah. So seventh conclusion, we introduced trading agents, a multi-agents LLM financial trading framework that realistically simulates a trading firm environment with multiple specialized agents engaging in agentic debates and conversations, right? Leveraging the advanced capabilities of LLMs to process and analyze diverse financial data sources, the framework enables more informed trading decisions while utilizing multi agents interactions to enhance performance through comprehensive reasoning. This is very important, comprehensive reasoning and debate before acting. Okay, this is what we miss in when human trades. So like suppose some human is trading alone, I mean you can actually, we do talk to ourselves, I mean most of the time, and that's what that like debate react principle, um, reasoning and acting, and then this comprehensive reasoning, self reasoning, where we actually create the counter example of it, and then we defend our position. That's what the debate part is there. So if I want to be entering long, why is the case? What are my reasoning behind it? And does my reasoning support this evidence? This claim, whether should I buy or not? Same goes for the bear side as well, bearish. If it's want to sell, like it should list out all the points why it thinks we should enter short in the market, and like they go on this debate back and forth, and you know the next response is sent to another agent, which actually assess that their their report. So it's basically it's basically a fully fledged trading firm, guys. I mean, this is what it is, technically speaking. Okay? By integrating agents with distinct roles and risk profiles, along with a reflective agent and a dedicated risk team, trading agents significantly improves trading outcomes and risk management compared to baseline models. Additionally, the collaborative nature of these agents ensures adaptability to varying market conditions. Experiments demonstrate that trading agents outperforms traditional trading strategies and baselines in cumulative return, Sharpe ratio, and other critical financial metrics, which we have already seen. See, it's outperforming every other metrics. Okay. Future work will focus on deploying the framework in a live trading environment, expanding agent roles, and incorporating real-time data feeds to enhance performance further. Okay, so this is what it is, guys. I mean, like the next step is to just put it on live and like see how it is, and that's what we're gonna be doing as well. But in the next couple of videos, we're gonna be understanding the model, how it works, and like evaluation metrics, what they have used, um, also like so in the appendix there is the real evidence and proof of how those results that we got, you know and yeah, all these like it has, this is really good, this is actually explaining what's going on beneath the thinking process of the AI agent, and it's just in pure natural language, which is just phenomenal, guys. It's amazing. The time we live in is just like yeah, the yeah. This is the time to actually grab opportunity in in agent based scenario, because see what we are seeing is like, I think I'm gonna actually start one series as well, like AI agent economy basically. So in internet world is what it is like this automation. Okay, and if you go ahead and like see on Upwork, N8N automation, you will see this like we can basically automate pretty much everything that's online task, um, with AI agents, which is this it is creating this AI agent economy, and like we have to get in this era of AI agent as soon as possible, and like because there's like lot of opportunities, guys, like really well opportunities. See this one, they're paying $10 to $25 for lead generation and email outreach automation. Just phenomenal. The no code tech specialist, N8N, Zapier, and AI agent development, 2500 dollars. And this is just the start of it, guys. Like you see, I mean, it just posted 12 minutes ago. This one 1 hour ago. Posted yesterday 4 hours ago. 5 hours ago. This one 2 hours ago, right? And there's like really a, l- a load ton of jobs on this one, and like what we are doing here is basically this automation. You see, we will be building this agent, this workflow, and it's just like automating it, right? So this is it for this video, guys, and I hope this will help you to get started in this field, and I'll see you guys in the next video. So thank you so much for watching, and yeah.